All right, so Christian, what I've got on the board for you is kind of the fundamentals of accounting. Every single transaction that occurs within a business has to wrap up into this equation and this balance sheet. Okay, so we're going to take a few minutes. I'll walk you through this. If you have questions, let me know. So this is your basic accounting equation. Everything that occurs in accounting will somehow fall into a component within this equation. So for example, assets indicate what a company is worth, okay? It's everything that the company owns. Cash, money coming in from clients that have either purchased a product or purchased a service. Inventory, that's considered an asset. Property, plant, and equipment, and land. We'll talk a little bit more about these here in a minute, but that's all of the asset side. Okay, so it's everything that generates worth for the company. On this side, on the right side of the accounting equation, you have liabilities plus owner's equity. Liabilities is anything that is owed by the company. Okay, so if they've incurred any kind of debt, then it would go in this bucket here. If they have an outstanding note of some sort, a mortgage, things like that, anything that the company owes is going to be a liability. Okay? Does that make sense so far?
That makes sense so far, yeah.
Okay. Then we have anything that's left over, and that's called owner's equity. Okay, and it's kind of a bucket of residual items. When we start looking at the balance sheet, we'll talk specifically about some of the things. But in essence, you have whatever the company's worth, okay, and then you have your liabilities plus any residual items over on this side, okay? And this equation always has to balance out. So in other words, when you add up liabilities and your owner's equity, it always has to equal the assets, okay? So there can never be one side heavier than the other. So how all of these are tracked? They funnel down into the balance sheet. And the balance sheet is probably the most important financial statement of any company, because the balance sheet shows where the company stands at any given point in time. Okay, so it shows what the value of the company is, shows what their liabilities are, how much they owe. So anytime they generate a balance sheet, it shows whether or not they're basically where they have enough assets to cover their liabilities or whether they don't. So you can kind of see where they stand. Okay, the balance sheet and the income statement are probably the two most important financial statements of any company. Okay, so your balance sheet then is divided. Takes this equation and then it divides it basically down the equal sign. Okay, assets are going to be always on this side, liabilities and owner's equity are going to be on this side. And the main thing to take away is that at the end of the day, both of these totals have to match. Okay? Okay. So, on the asset side, okay, if I asked you what you think your main asset was, just you as an individual, what would be some of those assets?
How much money I have on me,
okay,
what the clothes I'm wearing.
Yep.
Probably just the things I own, pretty much, like my phone, wallet.
You have a car?
Yeah, I have a car, yeah.
Okay. Key asset, yeah. So anything that you own, your cash on you, the cash in the bank,
mm-hmm.
all of those things are assets, and they would fall basically on the left side of your balance sheet. All of those things total up, and you get your grand total of all of your assets. Accounts receivable is money that is due the company. So if you and I, say I was a business, and I was selling you widgets, okay? So I make this widget, nobody else makes it, and you have to buy this widget from me. When I sell this widget to you, you now owe me money. Either you pay it as cash, or you give me a promissory note, or I keep it on account, and at the end of the month I send you an invoice. You owe me for this widget. So any money that is coming in that is due me, that I have not received via cash, I put into this accounts receivable bucket. Okay, so it's money that I'm yet to receive. So that's a key asset for most companies. Inventory, surprisingly, especially for your big companies like Walmart, anybody who sells a lot of merchandise, inventory is most of the time one of their largest assets. And you think about how big Walmart is and their distribution centers and so forth, they've got to have a lot of inventory. And then for manufacturing facilities, you have what we call PP&E, or property, plant, and equipment. And that's your buildings, any kind of manufacturing equipment, things like that. And usually those are pretty significant value as well. And then of course you have land. Land is also considered an asset. Okay, so does that make sense on the asset portion of the balance sheet?
It does make sense in the asset portion, yes.
Okay, great. All right, so now we jump to the other side. When we look at the right side of the balance sheet, we have two categories here, liabilities and owner's equity, again filtering down from our accounting equation. Liabilities are basically all payables, anything that I would owe as a company. So for example, if I am running a business and I'm consuming electricity, I usually will pay electricity, well, it kind of depends. If I'm paying based on consumption, then I'll consume over a month, and then at the end of the month, I'll usually pay the invoice or pay whatever it is that comes in, okay? So anything, well, actually that's an expense, a different payable. Okay, so mortgage, okay? Eventually you'll own a house. A mortgage is a type of payable because you owe it to the bank to pay back a loan if you've purchased a loan from them. There's accounts payables as well, which would be anything that I owe anybody who I've borrowed money from. And then you've got notes payable, which again, typically that's other, bank notes as well. So if I have, say I have a huge piece of equipment out there and I had to take out $1 million loan, that would go on my books as a note. So any kind of payable, any kind of liability, if I owe somebody something, it's going to fall into this area here. Okay? Okay. And then last, anything that's left over, anything that's not classified as an asset, not classified as a liability, it's going to get kind of dumped into owner's equity. Some of the most common things that you see in owner's equity is if we have any kind of investments, if we've sold our company stock, say I'm Amazon and I've decided to go public and I'm going to sell stock in order to bring in money. Those stocks those issued stocks would then be calculated or recorded in this area. Okay, so any kind of instrument that results in people paying me money to own a piece of my company. Does that make sense? That's what they would consider paid in capital. Okay, and then retained earnings, revenues, income. This is all of the income that my company is generating because of me selling whatever it is I'm making, whether it's a widget, whether it's a service, any income, any kind of revenue, it's all going to get dumped here. Okay? And then usually if I have to make any kind of contribution to the company, that's going to go into owner's equity as well. And the bottom line is that both of these sides have to equal each other.